For the last couple of years, all the talk has been about AI minds. Think ChatGPT, think Midjourney. But while we've all been fascinated by the software, a much bigger, more tangible revolution has been quietly building itself in the background, the AI body. And that's exactly what we're diving into today. Because here's the thing, while all the hype might be in the software, the real, lasting opportunity, it just might be in the physical hardware that brings it all to life. So, to really understand where we're going, we first have to take a hard look at where we are. And right now, well, there are some serious questions about the very foundation of the current AI boom. What we're seeing is this strange, circular flow of capital. A hyperscaler, say NVIDIA, invests billions into a hot AI startup. What does that startup do with the money? They turn right around and spend it on billions of dollars worth of chips from NVIDIA. Now, this paints a picture of explosive revenue growth, but as this quote points out, the optics are not great. It's kind of like giving your friend $20 just so they can buy something from your store.
And the amount of money we're talking about here is just staggering. We're looking at over $2.5 trillion projected to be spent on AI by 2026. This isn't just a trend, it's one of the biggest movements of capital in modern history. But it really forces us to ask the big question. When you look past all the circular deals and the hyped-up revenues, where's the actual tangible return on all this money going to come from?
So here's our game plan for this explainer. First, we'll examine the warning signs of a potential AI software bubble. Then, we'll talk about the pivot to physical AI, why it's happening, and why it's necessary. We'll get into the weeds of the Humanoid 100 supply chain, the real picks and shovels of this revolution. After that, we'll get practical on how you even value these companies before we face hardware's brutal truth. And finally, we'll look ahead to why 2026 is such a crucial turning point.
All right, let's kick things off with the AI software bubble. We need to dig in and really ask, is this incredible boom we're seeing built on solid rock, or is it standing on something a little less stable?
What's fascinating is how all these red flags are connected. You have the circular financing we just talked about, which then fuels an absolutely massive cash burn. I mean, look at OpenAI. They're projected to lose over $8 billion next year. Why? Partly because their most active users actually cost more to serve than they pay. But has that cooled off the market? No way. You've got companies like Palantir trading at 110 times their annual sales. To put that in perspective, investors are paying $110 for every single dollar of revenue the company makes. A healthy company might be more like 5 to 10 times sales. It's this kind of disconnect from reality that has seasoned investors calling it an extreme bubble.
Okay, so if the software side of AI is looking bubbly, where does the smart money go next? Well, it pivots. It moves from the digital world to the physical world, from electrons to atoms. And this isn't just some tech fad, it's a direct answer to a huge economic problem we're all facing. This slide really nails the shift we're seeing. Phase 1, the phase we're in right now, has been all about the AI mind. It's about language models, making images, creating text. It's all digital, a business of electrons. But phase 2 is about giving that mind a body. And that means robotics, it means autonomous action in the real world. It's a physical business, a business of atoms. We're moving from code that can write a nice email to a robot that can actually build a car.
So why is this pivot happening now? Honestly, it's pure necessity. As we speak, there are 10 million unfilled jobs in the United States alone. And the demographic trends are undeniable. In most developed countries, the workforce is actually shrinking. For years, the debate was, are robots going to take our jobs? Now the question is quickly becoming, will we have enough robots to do the jobs we can't fill? This massive labor shortage is creating a powerful economic vacuum that only physical automation can fill.
And really, there's no better symbol for this whole pivot than Tesla's Optimus robot. Now, forget about what it can or can't do today. Just look at what it represents. It embodies the ambition of this entire new phase, creating autonomous physical agents that can do useful work in the real world. This is the new frontier. This is where those trillions in AI investment can start generating real, tangible returns, not by getting you to click on an ad, but by solving actual labor shortages on factory floors. Okay, so this brings us from the big, abstract idea of physical AI to a really concrete investment idea. Look, if a robotics gold rush is coming, the smartest play might not be betting on a single gold miner. It might be betting on the companies selling the picks and shovels. This is what some analysts are calling the Humanoid 100 supply chain, and they think it could be the next Magnificent 7. So what does it actually take to build one of these AI bodies? Well, it's a whole ecosystem. You need actuators and motors. Those are the muscles that give the robot precise, powerful movement.
You need incredibly sophisticated sensors and vision systems, the eyes and nerves that let it see and understand the world. Power systems are the heart, keeping it running. But the supply chain runs even deeper. It goes all the way to the data centers that will be the brains for these robots. That means companies like Arista and Marvell making specialized networking gear, and companies like Vertiv, which make the cooling systems to stop it all from melting. These are the picks and shovels, the fundamental parts that every robot company will need, no matter who wins the race.
Okay, so we see the opportunity, but here's the catch. A lot of these companies are super young. Some aren't even profitable yet. So how on earth do investors figure out what they're actually worth? That brings us to valuing the robot revolution.
The gold standard for this kind of thing is a method called discounted cash flow, or DCF. The core idea is actually pretty simple. A business is worth the sum of all the cash it's going to produce in the future. The discounted part just accounts for the fact that a dollar today is worth more than a dollar 10 years from now, because of risk and inflation.
I just love this analogy because it cuts right through the noise. Imagine you could buy a machine that literally prints money. Would you care what it's made of or how much it printed for the last guy? Of course not. You'd care about one thing and one thing only. How much cash is this thing going to spit out for me, starting now? That's exactly how a smart investor should look at a business, and it's the entire logic behind DCF analysis. So how does it actually work? Well, you can boil it down to 3 main steps. First, and this is the really hard part, you have to forecast all the cash the company will generate in the future. Second, you pick something called a discount rate. It's just a percentage that reflects how risky the investment is. The riskier the company, the higher the rate. And finally, you do the math. You add up all those future cash flows adjusted for the discount rate, and you get a single number, the company's estimated value today. But that leads to the billion-dollar question, doesn't it? How can you possibly forecast cash flow for a robot that doesn't even have a price tag? Well, here's the key. You stop trying to value the robot and you start valuing the problem it solves. Analysts use a clever concept called labor-hour displacement. They calculate how many hours of a warehouse worker's time, for example, a single robot can replace. Then they multiply those hours by the total cost of that worker. Wages, benefits, the whole 9 yards. That number, projected over the robot's entire lifespan, becomes the foundation for your revenue forecast. It's not about the price of the robot, it's about the economic value it creates.
Now, before we all get carried away and start investing our life savings, we need a major dose of reality. Because investing in this space is absolutely not for the faint of heart. We have to talk about hardware's brutal truth.
It sounds so simple, but it might be the single most important rule in tech investing. Hardware is hard. With software, you can sell 1 million copies for basically the same cost as selling one. With hardware, every single unit you sell requires raw materials, a factory, shipping, and storage. It's a game that requires enormous amounts of money, and it is fundamentally, brutally harder to scale than software.
And because building hardware is so insanely expensive, these companies are always hungry for more cash. So how do they get it? They issue and sell new shares of their stock. This is called shareholder dilution. Think of it like this. You own a slice of a pizza. The company decides to make the pizza bigger, which sounds great. But to do it, they have to add a bunch more slices. So the whole pizza is bigger, but your personal slice is now a much smaller piece of the pie. This is a huge risk for anyone investing early in a hardware company.
And if you want a perfect, painful reminder of how this can go wrong, just look at WeWork. Here was a business dealing with physical assets that needed constant, massive injections of cash. As soon as the growth story started to crack, the whole thing just imploded. And the public investors who bought into the hype, they lost basically everything. It's a really powerful cautionary tale about the high-stakes game of investing in businesses that build things in the real world.
Okay, let's pull all these threads together now and look at what's coming. The year 2026 is really shaping up to be a pivotal moment. The era of just throwing money at ideas and pure hype seems to be ending. A new era, one that's focused on real results and actual return on investment, is about to begin.
I mean, the sheer scale of the physical build-out that's needed is almost impossible to wrap your head around. And we're not just talking about the robots themselves, we're talking about the entire infrastructure to support them. AI is expected to demand a 3.5 times increase in data center capacity, and that's going to require nearly $7 trillion of investment. This is the business of atoms on a global scale. It just proves that the future of AI, both its mind and its body, is completely tied to this colossal physical expansion.
So I'll leave you with this question to think about. We already know the titans of the AI mind, your OpenAIs, your Googles, your Metas. They've absolutely dominated Phase 1. But as we move into Phase 2, the much harder, more expensive challenge of building the AI body, the winners are anything but certain.
The race is on, and figuring out which companies can actually master the brutal truth of hardware, well, that's how you'll find the next titans of technology.